Have you ever thought about something while you're fighting with the market late at night, meticulously studying every candlestick? After a series of successful trades, do you ever feel a subtle sense of anxiety? You start becoming more confident, and perhaps even feel that you've mastered the rules of the market. At this point, are you overlooking the dangers lurking behind your success? We often hear investors say, "I did it right," or "I understand the pulse of the market." Yet, their next trade is often the beginning of their failure. Why does this happen? It's because the nature of the market is unpredictability. It can reverse at any time. Once you're in a profitable position, it's easy to fall into the trap of overconfidence. This is not just a psychological issue, but also a strategic failure in trading. You may ask, isn't profit something to be celebrated? Indeed, profit is the goal of every trader. However, the blind confidence and relaxed vigilance that come after making a profit are the most dangerous enemies. Jesse Livermore, the legendary figure in stock markets, understood this principle deeply. In his investment philosophy, profit does not signify the end of a trade, but the beginning of the next decision. Success does not mean victory, it means we have more responsibility to follow the rules we've set. Now, let's re-examine Livermore's trading philosophy from this perspective. We will explore how to apply his trading concepts to modern stock markets and how to deal with the ever-changing market dynamics. Trading philosophy, the critical point from success to failure. Livermore's path to success was not smooth. He experienced countless ups and downs in the stock market. What left the deepest impression was his multiple bankruptcies followed by comebacks. The underlying reason for this was his profound understanding of the nature of the market. The market does not stagnate due to your success, nor does it reward you for it. On the contrary, the market is emotionless, always evolving in the most unpredictable ways. In the stock market, every trade is a profound psychological test, and the line between success and failure is often razor-thin. This critical point does not arise from the market's fluctuations themselves, but from our inner emotions and decisions. Many traders, after initial success, often fall into an invisible trap, blind confidence. They begin to believe they have mastered the rules of the market and that they can always win in the stock market. However, this is precisely the root cause of their eventual failure. Livermore once said, "The market never stands still because of your success." The deeper meaning of this is that the market is emotionless and constantly changes in ways you cannot anticipate. Every success you have is temporary, and the next failure often lies hidden behind that success. Many traders, after a few successful trades, start to believe in their ability to predict the market, overlooking its variability and complexity. It is this blind confidence that becomes the catalyst for their ultimate failure. For example, you might have made a decent profit from a stock's upward movement, and at this point, you may feel like your judgment has reached its peak. As a result, you increase your investment and even begin to trade recklessly. However, the market is always filled with uncertainty, and your added positions and overtrading could lead to significant losses during a fleeting market reversal. When you ignore the complexity of the market and overly rely on your past successful experiences, failure quietly approaches. Successful traders gradually develop a mindset change. They no longer settle for just one correct trade, but rather turn their successful experiences into a rule, believing that every trade can easily replicate the previous success. This mindset overlooks a fundamental market principle. The market is constantly changing, and every successful trade is backed by a series of precise judgments and emotional control. Many traders, after making profits from the market, start to believe they've found a foolproof path and begin to take on more risk, over-relying on the correct trade they've made. At this point, they start to scale up their trades recklessly and even attempt high-risk assets they had never touched before. This inflated confidence ultimately leads them toward the edge of risk. Go with the trend is a core philosophy for many successful traders. We often hear successful investors, particularly legendary figures like Livermore, say that going with the trend is the key to trading. However, The real risk is not in the trend itself, but in finding the right entry point within that trend. Many traders misunderstand going with the trend as blindly following it, completely ignoring the short-term fluctuations and uncertainties of the market. When the market rises, some investors may become complacent after their success, thinking that the price will always move in the direction they expect. As a result, they increase their investments. However, the market is unpredictable, and it can fluctuate violently at any time. At this point, these overly confident investors may begin to trade against the trend, entering an already overbought market, leading to significant losses. In trading, investors often go through a transition from light positions to heavy positions. At first, they are always cautious, avoiding overexposure to risk. But as they experience consecutive profits, they begin to gradually increase their positions, aiming for higher returns. However, increasing position size does not necessarily lead to increased profits. On the contrary, it often exposes the investor to greater risks. Livermore emphasized the importance of position control in his investment philosophy. He believed that excessive concentration of positions is often the root cause of losses, while diversification can effectively reduce risk. However, many traders, after a series of profitable trades, begin to believe they can handle greater risks and start taking large positions. At this point, their money management strategy begins to falter. For example, in the 2015 Chinese stock market crash, many investors increased their positions during the market's upward movement, only to suffer significant losses when the market collapsed. This erroneous position strategy was the result of overconfidence following profitability. Therefore, Livermore always stressed that each profit in trading should not become the source of blind confidence. In his view, successful investors are those who can precisely identify market signals and make decisions at the right time. During the 1932 Great Depression in the U.S. stock market, Livermore successfully captured the market rebound signal by observing changes in market sentiment, leading to massive profits. However, it was because he understood that the market is always changing that he dared to exit at the right time after a profit, avoiding much larger losses caused by blind greed among many other investors. Trend identification and judgment. Real trends are opportunities for the few. In the stock market, trends are the core of successful trading. If you can accurately determine the direction of the trend, the rest is simply about going with the flow. But how do you judge the trend? Livermore emphasized that trends are not fixed. They are determined by market sentiment and the flow of capital. In today's stock markets, especially in the US and Chinese markets, trends are influenced by many factors, including policy changes, industry movements, and the global economic environment. For example, during the outbreak of the COVID-19 pandemic in 2020, the US stock market experienced a sharp drop, but after large-scale stimulus policies from governments around the world, the market quickly rebounded. This is a typical example of a trend change. One key principle in judging trends is to observe the relationship between volume and price. Volume is the lifeline of the trend, as it effectively validates whether the price movement has enough support. For instance, if a stock breaks through its previous high but the volume does not increase in sync, this breakout may just be a false signal. On the other hand, a real trend is often accompanied by a surge in volume at the time of the breakout. This is the key moment you should focus on. Once a trend is confirmed, timing the entry into the market is crucial. Livermore proposed the key point trading method, which suggests entering the market only when the price reaches a key point, rather than blindly chasing after the price. For example, when a stock breaks through a previous high with increased volume, this is an effective entry signal. However, having an entry signal alone does not guarantee success in making profits. The challenge remains in how to add positions and how to capture greater profits from the trend. Livermore's pyramid method of adding positions provides us with an answer. The essence of the pyramid method is, after the trend is confirmed, you gradually add positions according to market fluctuations, instead of going all in from the beginning. Taking technology stocks in the US stock market as an example, let's say you are optimistic about a leading cloud computing company and enter when the stock breaks through a key resistance level. When the stock price pulls back and confirms support again, you can choose to add positions during this pullback, thereby reducing your overall cost and enhancing the profits from the trend. If the stock price continues to rise, you can gradually increase your position until you build the largest position during the strongest phase of the trend. In the modern stock market, entering too early or too late is often one of the main reasons for failure. The key point trading strategy helps investors enter the market at the right time, at the right price, with the appropriate position size, and plan to add positions when the trend becomes clearer, thereby maximizing profits and minimizing risks. Identifying the key points in trend recognition, how to precisely capture market turning points. In the market, the starting point of a trend is often not immediately apparent, and many investors miss the optimal entry opportunity before the trend becomes clear. The so-called key point refers to the starting point where a significant trend is about to form in the market, often accompanied by changes in market sentiment, technical indicator breakthroughs, or major news events. The first step of the key point trading strategy is identifying this point. Typically, the following signals appear at the key points where a trend is about to change. Technical breakout. When a stock price breaks through a long-term support or resistance level, this often signals a strong trend. Chart patterns like breakouts from triangles or head and shoulders bottoms often suggest that the trend is about to start. Increased volume. Market volume tends to increase during trend reversals. The volume-price relationship is an important indicator for judging whether the market is in a healthy trend. If a stock breaks out and volume significantly rises, this is often a strong buy signal. Moving averages. The crossover of short-term moving averages with long-term moving averages often signals the start of a trend. For example, when the 5-day moving average crosses above the 20-day moving average, or the 50-day crosses above the 200-day moving average, it is typically a signal that the market is moving upward. Market sentiment. Certain market news or policy announcements can be key drivers of stock market trends. For instance, government stimulus policies may trigger a rise in the stock market. These signals often appear together at a certain point in time, and the key to precise entry is identifying the trend's establishment when these signals appear and entering the market promptly. Position sizing strategy. Increasing positions at the right time. In the early stages of the market, your initial entry might only account for a small portion of your total capital. You wait for the market to gradually confirm the trend before deciding whether to increase your position. The position sizing strategy is the second step of the key point trading strategy, which requires investors to reasonably increase their positions after the trend is confirmed, in order to maximize returns during the initial phase of the trend. The core principle of position sizing is to trade with the trend rather than to fight against the trend. When the market clearly shows a strong trend, the right position sizing strategy can help investors capture the dominant market movements and maximize profits. Key points of implementing the position sizing strategy include: add positions after trend confirmation. The best time to add positions is usually after the market trend has been confirmed, such as after breaking through key price levels or after a short-term pullback confirms support. If the stock price experiences a brief pullback and then quickly resumes its upward trend, this is a good time to add positions. The key to this action is ensuring that the market trend is clear and strong. Stage-by-stage position sizing. Position sizing is not something you do all at once. You can gradually add positions as the market trend continues to develop. The benefit of this approach is that it allows you to control risk during market fluctuations while averaging out the cost of your investment. Each time you add positions, it is advisable to gradually adjust your stop-loss points to ensure that you can stop out in time if the market reverses suddenly. Avoid adding positions when the market is overheated. The timing of adding positions must avoid periods when the market has already risen too much or when prices are far from support levels. Even if the trend is strong, the market could experience a sharp reversal. The best time to add positions is during a market pullback, when you can identify support levels. Mind position control when adding positions. When adding positions, you must control your overall position size according to your capital management rules. Do not expose yourself to excessive risk just because you are adding positions. It is generally recommended that each time you add positions, you should not allocate more than 1 to 2% of your total capital. This way, you can gradually increase your profit potential while ensuring that risk is controlled. An important part of the position sizing strategy is risk management. Even if the market trend is clear, investors still need to avoid excessive exposure to risk caused by over-leveraging. Position sizing actions must be closely tied to risk management to ensure that stop losses or position reductions can be made in time if the market reverses. Set reasonable stop-loss points. Each time you add positions, you must reassess the risk and adjust your stop-loss points. The stop-loss points should be adjusted according to market volatility to avoid setting them too tight or too loose. As you add positions, the stop-loss points should be adjusted accordingly, ensuring that the maximum risk of each trade is within an acceptable range. Maintain position diversification. When adding positions, you can also reduce risk by diversifying your asset allocation. For example, if you have already added positions in a particular stock, you can maintain a lighter position in other uncorrelated assets to guard against overall risk from fluctuations in a single asset. Let's use a real-life example to better understand how to apply the key point trading strategy in actual trading. Let's assume you are following a tech stock in the US. Market say, the stock of a major tech company. After some period of consolidation, the stock suddenly breaks through its 30-day and 60-day moving averages, and the trading volume significantly increases. Market sentiment is also starting to improve. At this point, your strategy is to wait for the breakout confirmation and enter the market, and then add to your position during market pullbacks. Precise entry. You wait for the stock price to break above the 60-day moving average before entering the market. However, rather than going in with full capital at the first breakout, you use only 1/3 of your funds to enter, leaving sufficient room for risk management. At this point, you set your stop loss below the support level to ensure the risk remains controllable. Adding to position. After the stock price rises by 15%, there is a small pullback, and the stock finds a new support level. At this point, you assess that the trend remains strong and decide to add to your position during the pullback, gradually deploying the remaining funds. Risk management. After adding to your position, you continuously adjust your stop loss to ensure you can exit the market promptly if there is a reversal. At the same time, you make sure the total position size after adding does not exceed your maximum risk tolerance. Through this precise entry and phased adding to your position, you can maximize your profits as the market moves upward while using solid risk management to ensure that losses are kept under control. Emotional control in trading. Overcoming fear and greed. In trading, emotional control is a critical component. Livermore deeply understood human nature and knew that most traders fail not due to a lack of knowledge, but because they are driven by their own fears and greed. Fear causes you to lose judgment when you are losing, while greed makes you overconfident when you are making a profit, blindly pursuing greater returns. So how do you overcome these emotions? First, you need to create a detailed trading plan that outlines the goals, stop losses, and position sizing strategies for each trade. During trading, strictly follow the plan to avoid emotional decisions. Secondly, you must learn to accept losses as part of the process. Any successful trader knows that losses do not equate to failure, but rather are the result of normal market fluctuations. The crisis that follows profits is often not a challenge posed by the market, but rather your inner emotional fluctuations and overconfidence in the trend. Understanding and applying Livermore's trading philosophy can help you stay calm, execute a disciplined trading plan, effectively manage risks, and achieve steady capital growth. Remember, the stock market is always full of opportunities, but only those who can overcome their inner fear and greed and strictly follow their trading plans will continue to profit in the market.